Taking Stock with Pim Fox and Carol Masser. On demand via our Bloomberg Radio Plus app. Free for iPhone and Android devices.
You'll be alright. No one can hurt you now. You and I'll be safe.
What's a day without some Taylor Swift?
In my daughter's world, that would be a terrible day without.
There you go. You see, a terrible day. Well, for a lot of investors, volatility is terrible. But for our next guest, perhaps maybe not so much. The author of The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. Joining us on the Ring Central phone line from San Francisco is the author, Tim McCarthy. Tim, great to have you with us here on Bloomberg.
Yes, thank you. I love listening to you. Listen to you almost every day.
Well, thank you very much. We appreciate it. Now, as the former president, chief operating officer Charles Schwab, and the president of Fidelity Investment Advisor Group, why the book? Why The Safe Investor now?
Well, it's interesting. I had written a bestseller in Japan some years back, and they wanted a sequel, so I thought I was writing it initially just for Chinese and Japanese investors. But then in doing work here in the U.S., because this has always been Mecca for me, I was surprised to see that U.S. investors are really missing out on a lot of very fundamental changes this century, notably in the fact that there's about 20 growth countries that have emerged. They're no longer emerging. And they're much more interesting and rated than they were before. And American investors are just missing that for the most part.
They are. That's interesting that you bring that up because we're in a time period, Tim, if you will, where we're very nervous about the emerging markets right now. And I group everything together because not all, probably incorrectly so, because not all emerging market stories are the same. What is your advice as we look at the volatility that we're seeing over in the emerging markets at this point, and how do we address it?
Well, you bring up an excellent point. There are different categories of emerging markets. And let me just say it in two ways. One, and this is the most enduring, is the fact that out of the 100+ different emerging countries, there are 25 that have really got a critical mass of infrastructure in place, and it's permanent, and it's not really reversible. And they're well on their way into a high-growth stage and quite interesting. There's another dimension now, in a way, to slice emerging markets, which is there are a group of countries that have made progress in varying areas of various areas, but have too much debt, don't have the reserves in place, and especially too much debt versus their GDP. And those countries, it's time for caution. And then likewise, politics is in all countries. Our own country here can get in the way. So we've seen a country like Turkey that had a lot of debt, plus then got into some political turmoil, and that can really hurt a country. Same, even more so, with Argentina. So slicing it by who's more politically stable, who has better reserves, less debt versus GDP is another very important way to slice the markets.
I got to tell you, one of the things I as I'm going through your book, I love that you've got a chapter, My Randy Old Great-Grandfather. Talk to us about this a little bit and your approach to how you wrote this book.
Well, it really is first off, from an investing standpoint, is an important lesson. We just don't prepare enough for how long we're going to live. We have life insurance in case we die. The good news there, if we die, we're fine. But people don't realize, particularly if they're already 50 or 60 and in decent health, that they're likely to far outlive the national average. And I talk about this a fair amount in the book. So what that means is you retire, you and your spouse at 65, you have to have your money last at least 25 to 30 more years, because one of you may well make it beyond 90, given that you're both already 65 and in decent health.
That's depressing, you know that?
Yeah, that's what my mother used to say to me. But the reality, that means then when you're even 70 years old, you need your money to keep growing, and you need to have some of it in equities, and you can't be like my Randy Old great-grandfather.
I got to ask you about Ireland. Doesn't that sort of ring any bell that, maybe 10, 15 years ago, people were saying, you got to invest in what's going on in Ireland. This is a boom. This is the Celtic tiger, Celtic tiger. You're seeing new kinds of information service businesses open up. They've got a robust financial industry. Did everybody see the collapse coming? Doesn't seem to be. I mean, I know Wilbur Ross managed to pick up a lot of the pieces with the Irish banking system, but how can you sidestep those potential landmines?
Well, the great news here is when you look at just how long you've got to invest and then how long you have to then take care of yourself, what that means if you're even 45, 50, you're going to be investing for a 15, 20-year period. And then when you retire, you're only going to be taking out what you need to live off of out of the market. So therefore, you've got a 30-year period. So that means you're investing over a 40, 50-year period. When you look at it that way, and indeed do trickle investing, not pulling in and out, what you see is that basket of countries you have, even if one goes into a 5-year big bust and big boom again, or boom, bust, boom, what you see is it doesn't really matter. Yes, a couple countries won't make it or fall out, but enough other ones will keep going. I'll give you an example, Pim.
All right, I'll give you about 10 seconds. I'm sorry.
Okay. I took the last century, said, what was the worst time to be invested? Fully, it was 1930. Guess what? It just didn't matter. You had plenty of money.
We've got to leave it there. I want to thank you, Tim McCarthy. He is the former president of Fidelity Investment Advisor Group, the author of the new book, The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. You're listening to Taking Stock on Bloomberg Radio.
Taking Stock, weekdays at 2 p.m. Eastern. In New York on Bloomberg 1130. In Boston on 1200 AM and 94.5 FM HD2. Or on Sirius XM Satellite Radio Channel 119. Copyright 2014, Bloomberg LP.